thought what I'd do today is just to kind of frame up the discussion is to kind of, use a analogy, if you like, or a thesis that I've heard from a guy called Bob Burnett. Some of you might be familiar with Bob. I was very fortunate to interview him at one stage, and he gave me a superb analogy that I think works really well, and it kind of just sets the table, if you like, today. So Bob's thesis is, roughly speaking, that the Bitcoin mining ecosystem requires a balance between miners of varying scales to ensure resilience, decentralization, and security. He talks about rabbits and horses and elephants, and we need different miners of different scales in order to strike that balance. Much like in the natural world, too many predators, you'll wipe out all the prey. Too much prey, not enough predators. It's just an imbalanced system. And so what he really speaks about is the need for us to get that balance. Rabbits are what he would call small-scale, individual home miners. Like rabbits in nature, they're numerous. They're quick to adapt, and they proliferate really rapidly. But they're vulnerable to resource scarcity, and they can lag behind in terms of accessing cutting-edge technology. In the case of mining, obviously ASICs. Horses, they're mid-sized mining operations. They're obviously vulnerable to resource scarcity, and but they're obviously a little bit more resilient than your rabbits. They strike a middle ground, offering flexibility and resilience without overwhelming the rabbits. And then we've got elephants, large-scale industrial miners, mighty but slow, rare and hard to hide. And they consume a disproportionate share of resources, whether it's hash rate and energy, and are pretty easy targets for regulatory or physical attacks because they're vulnerable. So today we've got an elephant in the form of Lincoln, not literally, and I don't know how you identify, Piers.
Probably identify as a rabbit.
Okay, more of a rabbit. But I think what this discussion brings today is really a perspective from a rabbit, a self-identified rabbit, and an elephant. Okay, and so what I've tried to do is really kind of sort of steer the conversation towards kind of attacking some of the key things that you might want to know from a large-scale industrial miner, and then some of the grassroots stuff that you see yourself engaging on a day-to-day basis. So let's start with you, Lincoln. You're obviously a very well-known company here in Australia. You've got a headquarters in Sydney. Your leadership team's in Sydney. We were chatting earlier, you've got a pretty decent-sized team. But almost all of your hash rate is in North America. What is happening here in Australia that has made it so unfavorable that you guys are able to actually do any significant scale of mining here?
Thanks, Dale. Look, might offer a couple of observations. So you're right, we're a 31 exahash business today, going to 50 exahash. It makes us one of the largest Bitcoin miners in the world. All of that hash rate is in the US and Canada, primarily out in West Texas. And in relation to why not Australia, look, fundamentally, I don't think there's any reason why we're not here. From a market characteristic perspective, it ticks a lot of boxes in terms of energy abundance, tons of renewable energy in certain parts of the country, which potentially would be very in line with the way we look at selecting sites. From a commercial perspective, however, I think the speed at which we could actually deploy capital into opportunities in Australia and then seeing a return from those investments in terms of these sites actually coming to life through various layers of approvals, etc., is a real challenge in this country, which is I think unfortunate. And when you're dealing with a commodity like Bitcoin, where every 10 minutes there's 3.125 Bitcoin up for grabs, every day there's 450 Bitcoin that don't exist tomorrow. If we are out there in the wind for 2-3 years waiting for, approvals to come through, it's a massive opportunity cost for us. Versus in Texas, for example, deregulated market, we are building at a rate of 50 megawatts a month, basically, which is at elephant scale.
Yeah. Okay. Fair enough. So TLDR, it's too hard. There's too much red tape, and this is probably a feature of a lot of commercial operations in Australia, not just Bitcoin mining. I guess from your perspective, Piers, being a rabbit, an occasional horse. What is the sort of scale and focus of the opportunities that you're looking at, like on a day-to-day basis?
Well, I started, probably like most of the people in the room, with just one mine, and grew it from there. And when you're operating at that grassroots level, you start to understand what the challenges are from going from one mine to 10 to 100. It introduces you to a whole bunch of challenges, from everything from how to manage heat, how to manage large amounts of electricity compared to what you're used to in your home. And then the business model of, do you buy your own miners and mine yourself, or do you provide hosting fabric for other people that want to mine? And what type of mines do you buy? Do you buy the latest ones, or do you try and hoover up mines that other people have abandoned? And when you're running around sourcing the kinds of opportunities that won't attract an elephant, but you can just about stretch to execute yourself or with the capital that you can amass as an individual pleb miner, it's a very difficult industry to play into in Australia. You have a lot of resistance. Most people have a negative opinion of Bitcoin mining in the energy industry. And for them, at the kind of scale that we can operate at with that constrained investment, there's very few energy companies that are interested in taking that kind of reputational and perception risk in exchange for what you're going to provide, which will be relatively small amounts of incremental income to their business model. So I can completely understand, if I was an elephant, why, contrast that against the environment that I've gone and personally observed over in Texas, where you can roll out 50 megawatt a month. It's obvious where you'd put your energy and your focus. But when you're starting out, you don't have that kind of capital or reputation behind you that enables you to roll out 50 megawatt in a month. Then you have to take what you can get. And so that's what I've done.
Okay. Yeah, that makes sense. And then back to you, Lincoln. So, I mean, obviously there's quite a lot of players within this, the elephant or industrial scale mining. A bunch of them obviously listed, and it's been said that it's like one of the most competitive, sectors on earth. Razor thin margins. You're constantly having to reinvest in equipment. You need to be able to, you've got these sort of cycles and everything to contend with. What do you guys sort of think is your secret sauce? Like, because everyone's probably got to figure out, like, how do I get some sort of operational edge relative to our competitors?
Yeah, that's quite a good one. So I would characterize the industry as like the definition of pure competition, where whether it's Piers or a rabbit or a horse, we're actually all competing for the exact same opportunity set, rewards. As it comes to large-scale industrial-scale mining, which is what we're prosecuting, there are a few benefits that accrue to scale players. I think first and foremost, obviously, it's a very volatile space, and when you've got more financial firepower behind you, you can weather the ups and downs a little bit more comfortably. The ability to scale capital, which is really important, allows you to stay in front of the curve as it relates to technology, etc. For example, upgrades in mining technology, new generation rigs coming to market, etc. And then I think finally, just the capability you build as a business around operations. Like, it's not as simple as just plugging it into a wall and mining the Bitcoin. Like, we're talking about large-scale data centers. You're dealing with hostile environments at times. You need to have a capable team out there making sure that we are looking after our miners in the best way possible, maximizing uptime and delivering a return to shareholders. Yeah.
Okay. And do you find, like, within this space, on the one hand, you're just trying to be as operationally sound as you can, but on the other hand, because you're in the public markets, you have to appease shareholders and quarterly earnings and all that sort of thing. So you kind of are fighting two fires at the same time.
I think that's all part of the opportunity. Obviously, the flip part of being a large-scale miner is the transparency and accountability that comes with being a listed business. That gives us the ability to raise that capital. So, all of that goes into the mix. I wouldn't say it's better or worse. It's just the way that the industry is sort of set up.
Sure. Okay. All right, Piers, we're going to shift gears to you. So now let's talk a little bit of specificity. Let's talk about some real life opportunities. Now, it's been said, obviously, like Bitcoin mining is like an energy dung beetle. It just goes and captures wasted or stranded energy wherever it might be in the world. Often that's like flared gas, or maybe it's waste management with methane and whatnot. We've had conversations, we've mentioned that, so I'd like to touch on that. But I thought what I'd do is just talk about a little example that I've come across, and I've seen you talk about it, where the UK is actually paying wind turbine operators to turn the turbines off because the grid can't handle the surplus energy. And apparently this cost £1.3 billion in 2024, and so far 252 million in 2025, roughly £180,000 per hour. And so you're kind of going like, all right, so you're wasting all this energy. I mean, literally paying people to switch it off. What, the elephant in the room, pardon the pun, is why the hell is this not being leveraged for Bitcoin mining? I mean, and maybe you've experienced engaging with these types of people.
Absolutely. In fact, this problem is so far spread all around the world. It's unbelievable. If you knew how much wasted energy there was. Virtually every solar farm in Australia right now is facing an existential crisis. They literally can't make their numbers make sense. They don't have a business, really. They literally are all studying what can we do with this asset, because all of us are producing power roughly at about the same time. And we're producing so much power, trying to push it into the grid at a time when the supply exceeds demand, and such that also sometimes the solar farms themselves have only a certain scale of connection to the grid. So let's say they're a 70 megawatt site, but they only have a 40 megawatt connection into the grid. So there's at least 30 megawatts that's essentially wasted, like it goes to heating up the ground. So a lot of them can't make their numbers make sense anymore once subsidies run out. So a lot of them are stuck trying to figure out how can we make money. Well, the only way they can make money right now is investing in batteries and shifting the time when they sell their electricity. But that's an enormously capital-intensive business. Buying like a megawatt of batteries is probably 10x the cost or the capital investment of buying an equivalent megawatt of Bitcoin miners, sometimes even higher than that. And so if you're a solar farm operator right now in Australia, you've got to be looking at Bitcoin mining and data center applications as an alternative to simply allowing that energy to be run into the ground. Traditionally, over the last 4 or 5 years, I've encountered heavy resistance, would be the most charitable way I could put it, from energy asset owners as soon as you mentioned the B word. So there's been a philosophical resistance to the whole idea of embracing Bitcoin mining, not based on anything other than the fact that a lot of these energy asset owners are in some ways co-opted with government or quasi-government players, such as very large pension funds, sometimes overseas-based pension funds with ESG directives, and they don't want to upset their sources of funding, which include government subsidies. So if you are, I guess, simultaneously running a business that's dependent upon these ESG directives and to some extent supporting a business or a protocol that in some ways undermines the supremacy of a fiat currency operated and run by those same governments, you're generally speaking not that welcome, especially if the incremental change that you can make to their bottom line is not that much. It's not worth it for them to take the risk in the reputation and perception issues that would happen from introducing Bitcoin mining at a place like that. But I've definitely noticed over the last year and a half that narrative is starting to shift, and it's through the work of people like Daniel Batten, who's been on this stage last year, has actually been very transformative in shifting people's perceptions just ever so slightly. We in Australia seem to be very slow to catch on to this zeitgeist, but there is a slight movement there. And I think we're getting a bit more permission to be able to operate and social license to operate, given the changes that we've seen politically in the US and a bit of a shift in the zeitgeist towards maybe Bitcoin is not such a bad thing now that governments are starting to embrace it, that ESG organisations like BlackRock have permissioned it. So some of the conversations that I've been able to have, some of the projects I've been able to execute and roll out are starting to indicate that there is some appetite to put a toe in the water here in this country.
So it almost feels like, on the one hand, from like a grassroots perspective, it's not the best thing in the world to have folks like BlackRock, embracing Bitcoin and co-opting it, for lack of a better word. But by the same token, what they are doing is kind of giving us a green light and saying, look, it actually is okay with you. So they've dropped a lot of the ESG stuff, and I've definitely noticed, there is a cultural shift. So perhaps those conversations will be easier in the future, but it just feels like, it's almost like financial advisors in the sense that it's more of a reputational risk right now to tell people to go and investigate Bitcoin or for them to even bother learning about it. Perhaps we're still at that stage with Bitcoin mining, but I think inevitably it's going to shift. Yeah, that makes all the sense in the world. Hey? I'm going to speak as a grassroots man here because I'm just a casual pleb, and one of the questions I've always wanted to ask one of the bigger miners was, the issue of centralization. It's something that we talk about all the time. Bitcoiners are always, like eagle-eyed, constantly very adversarial in our thinking. Always trying to think about, like, where are the risks? Where are the vulnerabilities within the Bitcoin protocol, broadly speaking? And one of them has been the idea of centralization within Bitcoin mining, particularly, correct me if I'm wrong, but somewhere between 30 to 40% of hash rate is through listed miners. And so some people say that's somewhat of a risk. And I'd love to get sort of your take as someone representing the industry, how you would, alleviate those concerns, or how do you think about those concerns when, shared by the Bitcoin community?
Yeah, I think it's definitely worth bringing up. Obviously, centralization is critical to Bitcoin. Nobody wants transactions to be censored, etc. So, firstly, the technical distinction is the pools that will be doing the censoring, but the thrust of the idea is, you've got, call it 30% of the network controlled by 20 or so large listed companies around the world. A few perspectives. Firstly, a lot of that hash rate is distributed across many, many different sites, certainly in different countries and continents. From a self-interest perspective, I don't think anybody in the elephant space wants to corrupt the network and therefore shoot ourselves in the foot, because we make a living from the incentives that are being, surfaced through the block rewards.
Yeah.
So, to the extent there was a nefarious actor, I suspect the network would evolve very rapidly to stamp that out. And then, in terms of the technicals around the pool, I'm sure Piers will have a view. It's actually super simple to direct our hash rate, 31 exahash of it today, across multiple pools at basically the flick of a switch. So to the extent you've got pools that are getting too large, it's quite easy to shift them. So I don't really see it as a massive issue. And then maybe the silver lining in some of this is, I think it is a reflection of where the industry is in terms of maturing and becoming more institutional, where, given how competitive it is, you're just seeing larger players sort of enter the space and sort of succeed in terms of their business models.
Kind of like a natural evolution of it. I think
so.
Yeah, that makes sense. And then actually I didn't include this when we were discussing in advance of what we were going to chat about today, but I thought, if you were to play devil's advocate and say, like, okay, there is a role to play for these, industrial scale elephant miners, what would you say is that role? Like, how do you, what do you think their role is from a, in terms of the good side?
If you're worried about the public miners all being suddenly shut down or their business model not working out, I think there's a growing narrative about whether, as an overall group, the public miners are running a sustainable business model. I think there's potentially some validity in that narrative, because it is a very, very hard business, and we know only some miners are going to make it from one halving to another. There is still one, I guess, a guiding principle that should put everyone's mind at rest in the room here, which is the difficulty adjustment. So even if tomorrow you shut down all public miners' contribution to the network, Bitcoin will be just fine. The network will continue to be hashing, and lots of people in this room will be part of the solution to keeping the hash rate going and keeping the network secure. When I have actually observed what happens when a mining farm goes bankrupt, and what does happen is, and I've assisted in the recovery of a mine that went bankrupt, and what I helped do for them was capture all of the remaining machines, refurbish them, and get them redeployed to other miners who basically went ahead and turned them right back on again. So Bitcoin is, if you've invested a whole lot in a public miner and they do fail, all that's done really is reduce the cost basis for the next person that picks up those same machines and finds somewhere to go plug them in. So somewhere, someone in the world is going to be able to run a Bitcoin mine profitably. It just might not be you. Bitcoin will be just fine. I think one aspect that a lot of people who are new to the industry don't understand is that even some of the public miners aren't actually mining. And some of the people that are home mining you're not actually mining, you're producing hash rate. And then you're directing that hash rate at someone else who's running a pool, and they're running a Bitcoin node, and they're running a special type of software on that node that's doing something called a block template. So it's basically assembling, most mining pools are the ones that are taking on the role of figuring out which transactions to include in a block. So that's generally speaking happening at the pool level. And obviously there's a bit of a debate now in my industry where we're talking about, well, are you really a miner if all you're doing is contributing hash rate and pointing it at a pool? Shouldn't you also be involved in choosing which transactions go into the blocks you're mining? And that's something that is actually happening under the hood right now.
I'm keen to talk about that, but before we do, let's talk about sustainability and the sustainability of elephant miners. So one of the things we obviously saw in the last cycle was rather than selling the Bitcoin, a lot of miners decided to just stick it on the balance sheet and then go and borrow a lot of money. And so when things went, downhill, a lot of these guys just found themselves completely underwater, like Core Scientific as an example. I'd be keen to get your take on, what you're doing at Iron to kind of ensure that you are profitable, sustainable, and perhaps you can give us some specifics around your operational and treasury management strategy.
Yeah, I think, across the space, the vast majority of the public miners hodl their Bitcoin, so they basically mine Bitcoin, raise equity capital on the way, keep that Bitcoin, and hope to sell it one day in the future at a higher price. Obviously, in the previous cycle, some pretty tough lessons learned across the space in terms of you've geared up your balance sheet to support expansion. All of a sudden, Bitcoin goes from 70 grand on to 15, and the time you don't want to be selling your Bitcoin is when you're being margin called to liquidate at the worst possible time.
Yeah.
That was pretty tough for a lot of people in the space. Iron doesn't do that, so there's only 2 or 3 of us that sell every single day. So on the way up, we sell every single day. On the way down, we're able to achieve a higher price because we sold on the way down. Doing that for 2 reasons. I think firstly, we're expanding massively, so every dollar that we spend holding Bitcoin is a dollar that's not going into growing the business and requires shareholders to be diluted even more. And then I think more importantly, it's 2025 and there are so many different ways to hold Bitcoin and express an interest in Bitcoin more generally. Like you can self-custody, you can buy an ETF, like buying a miner who's meant to be producing Bitcoin at a lower cost, just for them to hold their Bitcoin doesn't really make a ton of sense, at least for us personally. And then the risk profile, as we just talked to, around, you don't want to be holding bags at the bottom, and you'd be in a real...
You don't want to be a full seller, basically, as well.
Exactly.
Yeah. And I suppose, to your point, it's like that's not what the shareholders are actually wanting you to do. They want exposure to the mining operations, not necessarily exposure to the price of Bitcoin.
Exactly.
And perhaps the case was, and I hadn't thought about this, but in 2021, there were relatively few ways to get exposure if you were in traditional markets. We had GBTC, and MicroStrategy, no ETFs, of course, in any of the major listed stock exchanges around the world. So in many ways, miners were like a proxy. And it felt like in some ways people were using them as like a leverage play on Bitcoin.
Exactly. And there's more opportunities to express that interest today. And I'd have a big question mark as to what additional value are we adding by holding your Bitcoin for you, like fundamentally, when we are exposed to a variety of different risks around the operating business itself, the risk of a hack, etc.
Yeah. And you know what? So something you mentioned earlier, like you've got a lot of operations out there in West Texas. When you guys are looking, you're doing your sort of geographical analysis and looking at opportunities. If you had to just kind of zoom out, which are the jurisdictions that are screaming, green lights, and then which are the ones that are going, computer says no?
Yeah.
Like Australia.
Look, I think Piers touched on this earlier, right? There's tons of stranded, abundant renewable energy out there in the world, which by definition is the cheapest marginal form of generation, which as a Bitcoin miner, we love. We layer on top of that the fact that we're listed, and so our investment mandate is typically centered around sort of Western institutionalized markets, where we don't want to be running the risk of coups and having to recover capital in 6 months because the machines might get seized by a new government, etc.
Yeah.
And it needs to be bankable and financeable. So you layer that on top of each other. Places like Canada, our operations there are run by 98% hydroelectricity. In West Texas, where there is a massive challenge around intermittency through renewables, which we're having to sort of balance, those sorts of jurisdictions make a ton of sense to us.
Okay. Let's talk about that intermittent piece, because I think a lot of people don't quite see how they connect. So how does Bitcoin mining assist with renewables and with that intermittent piece?
Yeah, I've actually executed a project in the last year and a bit where we had to solve exactly this problem, kind of in reverse. So I was helping out a power station funded by, or run by, and fueled by your rubbish. So you put rubbish in your bin and you pay the council every quarter to take your bin away. You're effectively paying to give me fuel to make Bitcoin for you, for me, sorry. And that power station faced a terrible problem in that they have to keep their generator running 24/7 because you can't just turn off a gas-powered generator and then turn it back on again when the market wants it. You have to keep that thing running continuously. And this particular power station didn't have a battery, but they did have a grid connection. The problem is, while the sun's shining or the wind's blowing, power prices are depressed. In fact, depressed below their average rate of sales. So they actually have to pay money to put their power on the grid. They don't have either a load bank, which is just a big resistor that they can put that power into, and they didn't have a battery that they could time shift the power into. So instead we put a big container full of Bitcoin mines on that site, and we demonstrated over the course of a year that you could direct the energy produced at the power station while the solar panels were on and the power price on the network went negative. You could actually direct it to the Bitcoin miners, make money, more money than you would otherwise make by paying to put it on the grid. And then when the grid prices went back on again, you could slow down the miners or turn them off completely and maximise how much you make during those peak expensive times. So their revenue, if you like, looks like this. The power price becomes very expensive in the morning when you turn on your kettle and you make your coffee, and it becomes very expensive just as the sun goes down as you're firing up your oven and cooking your dinner just before you go to bed again when prices drop again. Basically, what we figured out at the end of doing a year of this was that if all you did was direct all the power at the Bitcoin mining box the whole time, you'd make less money overall than if you just sold it to the grid. If you only sold to the grid, you'd make, say, a certain amount of money. But if you sold to the grid at the times when it made sense to, and put the power into the Bitcoin mine at the times when the grid couldn't pay you as much as the Bitcoin mine, you made about 20% more money than if you just ran the power station onto the grid itself. So that was enough to create a business case to keep that containerized data center in play at that particular power station. So I guess in this case, you've got a power station owner who's got an asset they have to run 24/7. It's impacted negatively by the intermittency of the other renewable sources, but Bitcoin mining gave us a mitigation to generate money for that power station in those times when you otherwise couldn't. It's a bit of the inverse of what people expect would be the answer, which would be, why don't you put the Bitcoin mines where the solar farm is? The problem with that is you can only really monetize about 5 to 6 hours a day. So it's like 20 to 30% of the time your Bitcoin mine is running, which means that you're not making any money for the rest of the time, which means it takes you a lot longer to pay back the capital you invested in the mining infrastructure in the first place. And that puts you at an instant disadvantage to anyone else who can run 24/7.
Yeah. As you were talking, I started thinking about, okay, all of these solar arrays out there in the outback, but then that answered the question. I mean, literally, it's only operating for 6, 7 hours a day, let's say. Plus, I was also thinking about the question of, like, if you're out in the middle of nowhere and you want to locate your miners there, heating and cooling, it generates a lot of noise, it generates a lot of heat. How are you going to cool miners that are plonked out in the middle of the outback? I mean, practically, has this happened?
Yep. So we've actually, I've played in both air-cooled, which is probably the majority of you who've played around with mining have probably used air-cooled devices, which is literally fans blowing air over the chips that are inside your mining devices. What I've also done is work with technology known as liquid immersion cooling, and this is where you essentially dunk your computers in a big bath of not water. It looks like water, but it's actually mineral oil, the same oil that's used to cook your chips, more or less. And it's the difference between water and this oil is that the oil is non-corrosive and non-conductive. Okay, so in other words, it's perfectly safe to put your iPhone in or your ASIC computer, your mining computer, and it will just keep running. And the beauty about putting it in that oil is now you've put the heat into this oil that you can then run through a heat exchanger, which is like a big car radiator. You can hold that outside. And so now your delicate electronics are not in any way exposed to dust or air. So what we proved is that this is almost like running in solid state, so nothing goes wrong. None of the heat, like if you can run these things in a self-contained, hermetically sealed system, you can run them in 40-degree heat, no problem at all. So in desert conditions, these things are indestructible.
Okay. There's a will, there's a way. Things can work. Okay. I'd love it if you could share perhaps an example where you guys have gone ahead and, I suppose, kind of captured some of that underutilized renewable energy all over the world. I mean, I know you hydro and various bits and pieces.
Yeah. I mean, so there's two live examples for us. Obviously, in Canada, the example here is British Columbia. Tons of hydroelectricity built out, decades ago. A lot of that was being used to support the forestry industry. Obviously, with that industry in decline, where mills and pulp mills, paper mills, sawmills are shutting down, you've got all of this stranded generation out there. And because the government owns the entire network, they're going to recover their capex irrespective of what's happening in the market.
Yeah.
So we basically go in there, leverage some of that infrastructure, deliver them a revenue line that they previously weren't getting before, And today, we'd be in the very upper echelon of customers in that market, probably next after Rio Tinto with the aluminium smelting.
Wow, okay.
Right? Because the scale at which we operate across North America, 2.3 gigawatts, is almost half the size of the Swiss network where I grew up in WA. Like it's at a massive scale.
Okay.
And it's supporting those energy markets.
Oh, okay. Awesome. Thank you for that. I do want to switch gears here. You touched on a few things there earlier, Piers. Block templates, pool strategies. We got FPPS. We got oceans, tides. Let's do a little bit of in-depth, detailed stuff. Talk to us a little bit about, firstly, FPPS versus ocean pools, tides. What's the distinction? And then dive a little bit into that sort of block template piece you were talking about earlier.
I'm going to really, really simplify it for the audience because I know.
Please do for me.
Yeah, I know amongst us there's obviously I know this for a fact. There's some mining professionals. I see some faces I know in the audience, and I also know that there's some of you that for whom even what on earth Bitcoin mining is, you might still be grappling with that question. Essentially, FPPS is to cut a long story short. It is the primary method that most miners are using to get paid for the hashing service that they're providing to the network. And the way this works is basically someone else takes a risk, usually the mining pool operator, takes a risk of who and when a block is going to be found, and they basically pay you kind of pro rata in advance for the hash rate you're providing. And someone basically is backing them up and providing some capital to make sure you get paid. So that, as a miner, if it's important to you to get paid regularly on the dot for the service you're providing, then you're probably going to be predisposed to and incentivized to take on the FPPS model, where you get paid immediately up front for what you provide as you provide it. An alternative model is starting to come along because, of course, you get that great benefit of being paid reliably and continuously all the time, but you pay for that somewhere in what your reward is. Someone is taking that risk, they want a reward for that, and the way they get rewarded for it usually is by taking a larger clip of what you would otherwise have made had you been prepared to take a bit more of a risk over when and how frequently you get paid. So there's another mining pool out there that started late last year, known as Ocean Mining Pool. And it's sort of zagging while everyone else is zigging in the industry. And they're offering this retrospective, lumpier, but higher payout, ostensibly higher payout, for when the pool itself finds a block. It's an interesting conundrum right now. Which of those two models do you go with? It depends a lot on the financing of your own business and how long you can carry your costs for before you get a reward. But I've certainly tried it, and anecdotally I can tell you that the rewards are very few and far between, but when they come in and you then do your numbers, it works out somewhere between 14 to 16% more in your pocket as a Bitcoiner than if you simply took the easy, cheap, getting paid regularly option.
Okay. And then, while you're talking about the technical aspect, let's just touch on Datum versus Stratum V2. Give us the TLDR, define the two, respective pros and cons of each. I've got laughs in the audience just by mentioning that.
Look, this is an interesting one. There are some centralization risks with the way we're currently running pools, and the current way we're running them is, broadly speaking, known as Stratum version 1. And a proposal came out a few years ago to take that up to a notch to Stratum V2, and that would create, I guess, a much more decentralized version of how we're currently running pools and selecting blocks, etc. The problem at a practical level for that is how much has to change, and the incentive to change is not really there for either the pool operators or the miners. So yes, this would be a good thing to do for Bitcoin, but no one's going to pay me any more to do it. So again, the same folks that thought up this idea of Ocean Pool being get paid as blocks are found versus getting paid as you go. They also had the idea of simplifying the decentralization of creating block templates, which is what Stratum v2 could have solved, by essentially turning it into a very easy to install app that you can put on top of an existing node, so that a miner could in fact not only produce its own hash rate, but also point that hash rate at its own block template builder, which it can run on its own little node, and then it can either contribute to a pool or solo mine if it wants to. So yeah, that app is now out there. It's available on most of the little node boxes that you can buy, the packaged ones. And it's very lightweight, very easy to run, and it makes it trivial for even a rabbit miner to be able to build your own blocks and actually be a miner as opposed to simply a hash rate provider.
Okay, well explained. I think it gives us a good sense that increasingly within the industry, there are solutions that have been built out to facilitate greater decentralization. That seems fair to say. All right, I'd like to ask you a question there, Lincoln, about kind of how you guys have looked to diversify your business, because I obviously noticed that it's not just Bitcoin mining. What you seem to have done is also pivoted into AI cloud computing and repurposing some of your data centers. So I'd love for you to talk to us about kind of what you've done, why you've done it, and what are some of the benefits you've seen so far.
Yeah, so I guess, the founders of Iron, Daniel and Will Roberts, set up this business 6 or so years ago. And the core thesis is around building data centers close to the source of excess abundant renewable energy. And initially, that first use case, which we've talked about, Bitcoin mining, was a great way to monetize that platform. Why? Because there's basically no counterparties. It's the Bitcoin network. You can get paid more or less straight away. The moment you put a machine in and starts hashing, you're getting a return. It's a great business. They'd always envisaged other applications coming to the fore over time, and what we've experienced over the last couple of years, obviously, the very rapid emergence of artificial intelligence, has basically caused a lot of demand for the underlying power, land, and data center infrastructure required to really power AI. And so, given the amount of money being spent by the biggest companies in the world around AI products, there's been a huge power crunch that's basically competing for the same megawatts as Bitcoin mining has been historically. So at Iron, we do two things, right? We've got the Bitcoin mining. We run an AI cloud service where we've got NVIDIA GPUs literally side by side with our Bitcoin miners in the same data center. We've obviously customers on the back of that. We also have a massive portfolio of power and land assets, which we are building out new data centers for in terms of supporting the next generation of liquid-cooled Blackwell GPUs from NVIDIA. And just looking for, I guess, more diversified ways of monetizing that portfolio, which shareholders are looking for, just given the volatility that we see in the Bitcoin mining space.
Yeah.
And the great amount of capital, that exists to support more traditional sort of data center, AI technology workloads.
Yeah, and I suppose the timing of it is quite fortuitous in some ways, because perhaps if we were 4 years ago, there'd be a lot of, negative publicity about the amount of energy that AI computing is, consuming. Whereas now, I think a lot of people have seen so much benefit. Plus, we also see, obviously, the ESG narrative has somewhat tamed over the last few years. So it feels like a good time for you guys.
Yeah, I mean, the fact that we're 100% renewable as well does help in the
Yes.
conversation. Like, I don't think we're seeing people wanting to pay more necessarily for that sort of compute, but at some stage you can't be ripping through millions of liters of water just to power a ChatGPT query. Like, there are, technology is advancing in a way that is much more sustainable, and if you can tick two boxes at the same time, deliver a great product that is also sustainable, it's going to be table stakes one day.
Yeah, cool. All right, I recognize we've got 5 minutes left, and I thought I'd throw this one out to all the wannabe home miners out there. I also want to be a miner when I grow up. Okay, Piers. So there's a couple things here. I've got some great solar panels. The rebates I'm getting are appalling. I'm thinking of buying a cheap second-hand miner and switching that puppy on, and I'm not giving any power back to the energy utility company. Is that actually viable? And how would you compare that versus something like a BitAxe, just in terms of the economics?
The first thing I say to people who ring me up, because I get this question about 3 times a day, is friends don't let friends mine. So if you want to end up with fewer sats than you have right now, mining's a great way to do it. So most people should not mine, unless you have some kind of edge, unless you have access to very large amounts of free power. You really should not play with this stuff at any major scale. The beauty about a BitAxe, and I see there's someone here, I think, marketing some BitAxes in the exhibition hall, that strongly encourage you to go around and have a play. If you've got an itch you want to scratch, you want to be involved in mining, you want to learn about it, go ahead and buy a BitAxe. They're about a $200-300 unit. You can learn a lot about mining from that device, and it won't kill the power circuit. You'll be able to keep operating your fridge, television, your microwave without blowing up your breakers at home. It won't create this obnoxious noise or get you a divorce proceedings from your wife. So yeah, getting a BitAxe is a great way to dabble and play with mining. Now, how should you figure out and set up a BitAxe? The standard advice I give to people who ask me this question is buy 2 BitAxes, because this will teach you more about mining. Buy one and then configure it to mine on a pool, and you will get a payout in lightning payments, a little trickle of sats every month that no one will know you have, by the way. And then the second miner, configure that to be a lottery miner, so that maybe you'll be one of the people that makes 3.125 Bitcoin for finding a block. If you think it can't be done, you're wrong. It's actually happened. In fact, I met a fellow up in Cairns who wrote the mining pool software that someone used a BitAxe and pointed that hash rate at the solar mining pool there and got the 3.125 Bitcoin for a $200 or $300 investment. Good on him. But recognise that it is a lottery ticket that you're unlikely to win the prize from in many thousands of lifetimes. But probably a better lottery ticket odds than, and certainly far more fun than buying a golden casket ticket. So yeah, that's probably where I would point someone who, in the first instance, who wants to play around with mining. Try and avoid buying an S19 and trying to find out what that's like.
All right, with 1 minute left, like if you wanted to do mining as a service, you got a lot of these providers. With 1 minute left, tell us if it's a good idea.
If you can't quickly go to the data center where your mine is hosted and verify yourself, in other words, you're mining somewhere like China or in a foreign country that you can't easily go and visit and verify, or if the mining hosting provider won't tell you where your mines are located, you are essentially participating in what I would call the rug pull waiting room, where you are essentially waiting for that email or the silence that might happen when your miner needs repairs and is suddenly switched off. So you're just hoping that you can recover the value of your investment and then a little bit more before the music stops.
I think that is a superb note to end it. Thank you so much for both of your perspectives. I think we've learned a lot as a group about what it's like to be an elephant, what it's like to be a rabbit, or an aspiring rabbit. Thank you very much.